are a few bigger topics in the world of finance than inflation right now. On Wednesday, the 24th of May, the Office for National Statistics will publish the figures for the month of April here in the UK. The reading has come in higher than expected for the last couple of months, thanks to advances in the price of salad, bread, meat, cereals, restaurants and hotels, and despite a retreat in the cost of fuel on the garage forecourts. As a result, in March, the Consumer Price Index, or CPI, rose 10.1% year-on-year, the seventh straight month of 10% plus inflation. The Bank of England's preferred measure, the CPIH reading that includes owner-occupier housing costs, that increased by 8.9% year-on-year, and the Retail Price Index, or RPI, rose 13.5% year-on-year, although this is no longer an officially recognised statistic. I wonder why. Now, the Bank of England can print money, but it can't print salad, bread, meat or cereals, and some will argue that increasing interest rates to correlate inflation is to use a blunt tool, because the idea behind higher borrowing costs is to decrease demand for credit and decrease end demand for goods and services. Everybody still has to eat, though, so this is a sticky issue, although the Monetary Policy Committee will note with some concern how the rate of inflation, as measured by the core CPI index, which excludes volatile items like food, fuel and alcohol, is still stuck north of 6%. That's just not coming down. And that's what's driving wage demands from workers, whether they're public or private sector, unionised or not. And policymakers' key concern may remain that wages rise, fuel demand, stoke inflation, prompt more wage demand, and ultimately create a sort of vicious spiral that bedeviled the 1970s. That resulted in inflation and interest rates both going way above 10%, helped along the way, I must say, by a couple of oil price shocks. That chart makes the current Bank of England base rate of 4.5% really look pretty modest, especially as it undershoots inflation by nearly 6 percentage points. Hard to believe as it may be, this means that monetary policy is still actually very loose because real rates are negative, and in the 1970s and 80s, successive chancellors of the Exchequer kept interest rates above inflation in the fight to suppress it, and therefore real rates then were positive. Markets are pricing in another couple of rate hikes to a peak of 5% this time around before the first rate cut in February 2024. On the company front, we're now getting a run of first half or full year results figures from firms that have a March or September year end, so there'll be plenty to study, especially as a good few trading updates are due as well. Names that may be worthy of further scrutiny include the following, although some of these dates could yet be subject to change. Wincanton and Big Yellow on Monday the 22nd of May. RS Group, Cranswick, Helical, Tops Tiles, Watkin Jones and Avon Protection on the 23rd. Kingfisher, Severn Trent, Aviva, Intertech, Marks & Spencer, C&C Group and N Brown on the 24th. And United Utilities, Johnson Matthey, Workspace, Kinetic and Pets at Home on the 25th. Now there's not a lot due on Friday the 26th, but the company that could cause the biggest fuss in the week overall is SSE. The owner and operator of gas-fired power stations and wind and hydro power plants, and grid and transmission network operator, is due to report full-year results for the 12 months to March on Wednesday the 24th of May. Just under 60% of SSE's 9.3 gigawatts of power generation capacity comes from conventional thermal stations and gas storage, while more than 40% comes from wind and hydroelectric. In terms of earnings, power transmission and distribution via regulated networks are the biggest earners, followed by energy generation, but do note that renewables so far, their contribution is pretty marginal. The shares are broadly unchanged over the past year, but that does mean they're trading near an all-time high after a pretty big rally since the autumn. The shares seem to have cast aside worries over windfall taxes, oil and gas price volatility, and disappointment over the sale of a 25% stake in the transmission business rather than the breakup of the entire company once advocated by activist investor Elliott. Indeed, investors are now focusing on January's third quarter trading update, which upgraded earnings guidance for the year to March, and also the long-term goals for growth in earnings per share and dividend per share as outlined by 2021's Net Zero Acceleration Programme, or NZAP. In terms of the full year figures, there are two numbers that will really make the headlines. The first is adjusted earnings per share, where SSE upgraded guidance again to more than 150 pence a share, with its initial estimate of 120p alongside that January update. Now, those figures compare to 95.4 pence a year ago. Chief Executive Alistair Phillips-Davies cited sales mix, good power availability, lower forward energy and gas prices, as well as clarity on the electricity generator levy or windfall tax as reasons for the upgrade. They also combined to offset the impact of lower than expected renewables output across the portfolio. If Mr. Phillips-Davies gives any guidance for fiscal 2024, well, remember that SSE's goal under the NZAP is to generate compound annual earnings per share growth of 7 to 10% a year out to March 2026. And the second headline figure is the dividend. SSE has targeted last year's payment of 85.7p plus an increase equal to the retail price index inflation rate, and analysts have therefore popped in as their forecast 96 pence a share. For fiscal 2024, however, SSE will cut the dividend to 60p a share to help fund the development of its portfolio of renewable assets. The plan thereafter is to grow that figure by around 5% a year. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.